Like we want investors that are like knowledgeable, can ask hard questions. We'll give you answers. We'll tell you when we are making assumptions, because assumptions are certainly made. They're based on data, but this is a future projection. Like we don't know what's going to happen, and they grasp all that. And that tends to come with bigger checks, to be honest. Like writing a 50K check means I'm going to ask the questions that I need to ask. And maybe writing a 10K check is more kind of cavalier.
Welcome to the Path to Passive podcast, where we talk about building wealth and empowering lifestyle through commercial real estate investing for tech professionals. I always wish that other tech professionals reaching financial freedom had documented their journey along the way, so I'm doing it for the rest of us. Join us as we explore stories, many failures, and lessons learned along the way. I hope you enjoy and subscribe. Hey, today's guest is Christopher Lento. I just got done recording with him, and I had an awesome conversation. We got to learn about his story of, him getting into real estate from just curiosity, sheer place of curiosity, from being someone that leased and rented inside of an apartment to learning about the industry, learning about how the model is actually put together from his landlord, the person he was renting from, and just kind of exploring from there his path to learning and, really doing real estate in parallel to his W-2, his job as that mechanical engineer, and just learning over time, acquiring more and more property until he saw what was the big picture, as he called it, or the writing on the wall, that seeing what his options were for his career, his bosses' bosses, and just, that's like seeing where can I possibly go with this career path and looking at the things that he enjoyed most, which was real estate and building that exit plan. So we get to discuss his story, some of the challenges, some of the thinkings, the frameworks that he had, not so much like the challenges of things went absolutely terrible and resilience and those kinds of things, but more of the life aspect of, if I'm at this place, do I really want to continue down this path, and making plans on how to leave his job, thinking about that and some of those considerations. That's what I refer to. We also get in some of the nuts and bolts of real estate, his, what his firm invests in, how we work with investors. And there's some really cool tips about the process at the very end as well that I think is very key for people that are looking to make their first, maybe even second investment in real estate from a perspective of being a limited partner. So this is one you're definitely going to want to check out. Take some notes as always. And if you want to learn more about this kind of thing, please subscribe to the newsletter. You can go to aritacapital.com and check that out. And of course, I urge you to go and check out all of Christopher's stuff as well. He's got some good material, educational material as well on his site, which is in the show notes. Thank you so much and enjoy. Welcome to another episode of the Path to Passive podcast. I'm Stephen Rita, your host, and I am super excited to have Chris Lento on today. Chris Lento's journey begins with, well, we would say engineering precision. You have your background in mechanical engineering, right? You're working for defense programs and defense industry, and that's where your story unfolds, as we're going to get into, where it was right after college you started buying real estate and learning more and more, thinking about how are the people around you doing it. And so you have sparked your curiosity, and that's really how you got into real estate, to the portfolio that you have today, and starting Engineered or Emerging Markets Capital. Is it EM Capital?
Yes,
and so
EM, Emerging Markets. Yeah,
that's super cool. And I saw that, and that was right on it. So I'd love for you to introduce yourself, Chris. Talk about a little bit of your background, and really just take the story on as well. Like, how did you get into real estate? What were those curiosities that you saw to really push you into getting into real estate more?
Yeah, absolutely. And I'm happy to be here, Stephen. Thanks. So I graduated with a mechanical engineering degree, started working for a defense kind of research and development / defense company in Cambridge, Massachusetts. And like moved into my first apartment in the Boston area. And Boston has a lot of these 3-deckers, which are like 3 apartments stacked on top of each other. There's like, tens of thousands of them around all the neighborhoods. So I'm living in one with 3 roommates, and we're paying what I thought was a lot for the time. And there's 3 levels. And I'm like, who owns this place? Like,
Right.
how much does it cost? What's the mortgage? Like, is this guy just like raking it in?
Mm-hmm.
It seemed to me like that's what's going on. So I met him and we talked about it, and he was like an engineer, an electrician, and him and his brother had bought this building like 10 years ago and like done all these reservations on it. And he was kind of a strange guy. And I was like, oh, like he's not like this millionaire. Like
Right.
that,
Right.
it seemed doable, right? Like
Yeah.
it
Yeah.
gave me
Yeah.
confidence.
If he could do it, I can
Um,
do it.
right, right. And then so I like maybe about 6 months later, I got this is, I'm old, right? So this was like early 2000s. So the web was around, but it was kind of useless. There's no
Uh-huh.
podcast. There was no, I don't know. So I got a couple books, from
Nice.
Amazon, and,
Uh-huh.
just like read them. And one of them had like how to build a model, like a underwriting
Mm.
model basically. And, put that together, and then started talking to brokers in the Boston area. And I just like wore out a couple of young brokers. Like just like
Nice.
every
Love it.
weekend, I would just go look at apartments and be like, huh, like this would work for me if it was $100,000 less.
Yeah.
And the prices were like $500,000. Like they were not that expensive. Um, and I just did that for like a while, and then saved up for money, some money, borrowed a little money from my father, and then
Mm.
bought a 3 unit with an illegal in-law in the basement near the airport in a like a less desirable neighborhood, but that was definitely like up and
Yep.
coming.
Cool.
And then I moved into that, basement unit. And then when one of the units above vacated, I moved up there and like
Mm-hmm.
renovated it. Did that again, and then lived there for like a year and a half, and then bought another one up the street, did something similar. And that's sort of how I started. I had my regular job.
Mm-hmm.
And at the time I like loved it. I'm like, this is great. Like,
Your job?
these like real estate closings are more exciting than anything going on at work.
Oh, sure. Yeah.
Um, but I didn't see it as a career. I was like, this
Mm.
is great. I can do it on the side. Maybe I'll get one every 2 years and have this
Mm-hmm.
like portfolio for retirement. I wasn't really
Mm-hmm.
thinking like of transitioning or even like big picture. I was managing them myself. It was very manageable. There's like some mental overhead with it.
Right.
The actual things I had to do weren't that time consuming.
Yeah, I think it's interesting you say that here, right? Because I was listening to some other podcasts and learning more about you, and you were talking about how just having it wasn't often. You were saying people often talk about the three T's, right? The termites, and the trash,
Right.
etc., and how that's something that happens frequently, but that wasn't so frequent for you. But it was still that mental real estate that man, when you got the call, just like I got to go take care of something, right?
Right. Yeah. Yeah. So I had 7 units, like I said, maybe, or like I said before, maybe like once a month something would happen. Like it
Mm-hmm.
wasn't often,
Yeah.
but when it did, like it's like a Sunday morning and you see the number and you're like, oh my God, like,
Yeah. Yeah.
like
It's
my day
ops,
is
dude.
probably ruined.
It's operations. It's you got to take care of it, right?
Right. Right. Um, so then I grew that portfolio. I expanded it to like a market like an hour outside of Boston,
Mm-hmm.
because I sort of like was introduced to the idea that some markets are better than others. Like at a really macro level, there's a rent to price ratio, right?
Mm-hmm.
And like
Yep.
some markets, just say for a condo or something, for a condo that you could buy with a monthly mortgage of say $2,000, you could rent it for $2,000. And there's another market where you could buy a condo with a monthly mortgage of $2,000 that you could rent for $2,500, just
Yeah.
because the markets are different. So then I was like, all right, well, I'd always learned, invest in your backyard.
Yeah.
And that's what I was doing.
Where right?
Then,
That kind of thing.
right. And then I was thinking, well, if there's better markets, let me find better markets. And then, well, what are the challenges of operating in those markets where I live in my market? So I bought something about an hour away, tried to treat it like it was Florida. I'm going to go there once a quarter. I'm going to hire a professional property
Smart.
manager. I'm going to sort of like learn all the lessons, but I can get there if I need to.
Right.
And that went really well. And I had the benefit of the market being kind of with me.
Mm-hmm.
So I had that for 3 years, sold it for a good profit, and then 1031 exchanged it into a real property in Florida,
Super cool.
which I, only visited like 3 times a year and proved out my model.
Was that also
So
as an investment thing, or was Florida something more personal?
no, that was a 24 unit.
Oh,
So it
cool.
was, yeah, it was a
Very cool.
bigger property. So I went from a home equity line of credit on one of
Hmm.
them, took that, bought a 5 unit, took the 5 unit, 1031, exchanged it into a 24 unit, which I actually still have. Um,
Super cool.
so that was sort of like testing it out on the personal side. And then in parallel, I sort of got to the point in my career where I could see like the whole path. I had moved to Washington, D.C. for a couple of years, was working with our Navy
Hmm.
sponsor, and I
Hmm.
saw like the procurement side and like kind of our companies. I was in program management at the time, and I kind of saw the whole picture. And
Which
I
picture
didn't like
of
the picture of like
investing or
where
like
I
your
could go
career?
in the Defense Department,
Got
right?
it. Yep. Yep.
Like I want to be my boss's boss's boss. Like, what does he do, and who does he interface with, and what's
Yeah.
his job like?
Yeah.
And it
The
really
writing on the
involved a lot
wall,
of
so to speak, right?
traveling to the West Coast to, kiss the ass of the Boeing brass and
Yeah. And everyone else that you need to play politics in the career, right?
exactly. And I was like, this does not seem like something I want to do.
Yeah.
So I started ramping up the real estate and kind of got introduced to the idea of, getting investors. Because when you're
Hmm.
doing your own money, you have to sort of like get a pile of money from your rent and your job and then buy something
Scrape
and
it
then,
together, do something else,
right,
and
then
then,
wait,
yeah.
right, and then do it again. So it's tough to scale.
When did
And
that challenge come for you? Like, you talked about, getting the couple that you had. The first one, you lived in the basement. Statute limitations are way over here, so I think you're good.
right, I'm
Uh,
good. I've sold that.
so, and then another down the street, and then you talked about having that one that was an hour away that you 1031 into the one in Florida. But
Yep.
did you have like a couple of properties, maybe like 12, 15 units by then?
Yeah, I had 12 units by the time I
Okay.
1031 into the Florida property.
Okay, cool. But by the time that you were seeing the big picture about the career where things could go, you had a little bit over 10 units where you were getting some decent cash flow in already,
Yep.
right?
Right. Yeah.
Okay.
So I expanded to Florida. Yeah. So I had 30, over 30 units by that point. So I had like
Yeah, yeah.
decent cash flow. And that's where this stuff all kind of came gradually, right? Like there was other some markets are better than others was like a
Right,
thing. I'm like, oh, okay.
right.
What does that mean? And then there was, once I got the Florida one, I was like, oh, I can manage out of state. I set up
Hmm.
my processing procedures, how to
Yep.
hire a offsite property manager, how to manage them.
Hmm.
It's not passive. I talk to
Right.
them. I have a Zoom meeting once a week with every single property manager. I have
Hmm.
a spreadsheet they fill out weekly, monthly.
Review the
It's a fair
metrics.
amount of work. And if
Yeah.
something comes up, like I have an insurance claim on that property right now, like I'm kind of running that. Like
Yeah.
they're supporting me and like getting bids, but I'm
Right.
the hub.
You're driving. You're driving it.
Yeah.
So,
Um, so I think, yeah, like the location thing was my first sort of revelation. And then the second was like scaling with partners, basically. Like that there's
mhm,
equity partners out there that don't want to be involved, but will, take a cut to give you all or some of the equity. And that allows you to just scale faster.
who are willing to put in capital, right? Put in
Capital,
equity, put
right?
in capital,
Capital,
so that
exactly.
they can be part of the deal.
Yep, exactly. So then from there, I partnered with a group that had a good deal under contract in Kentucky, and I had been like making the decision to expand into this during this time,
With
and I
partners,
decided, what's that?
with partners to
Well,
expand, you mean?
I basically was like, all right, I need like a 2 year plan of how to make this my career because I was
Got it.
sort of not needed an off ramp, but felt that where I was going in my W-2 job was not where I wanted to go. And
Hmm.
like the opportunities there were, it was either switch industries, like out of the defense industry, or go towards real estate, which I was excited about. I liked, it
Yeah.
didn't feel like work.
So you needed an exit plan and something you enjoyed more.
Exactly. And then I started, kind of like reaching out to friends and family, gauging interest, like, hey, I have these 30 units. Here's how they're doing. If I could find another one, would you be interested in investing? And I set up the syndication structure and kind of did all the back end work that was needed. And then I partnered with a group that was looking for capital and I raised capital on that deal and came in as a pretty active general partner. So I raised capital, but I also kind of ended up running the whole deal
Cool.
in the end. Yeah.
Substantial duties, material
Substantial
duties.
duties, certainly. More duties than I was paid for, I'll tell you that.
But you learned.
I learned a lot. Yeah. Yeah.
Yeah. How, you talked about it being a slow burn, right? Or gradual. I forget exactly the word you used, but it took time to, get these properties, and also the revelations. One revelation you talked about was the out of state, or the different markets out there, right?
Yeah.
Um, how, like, over what time span is this up to that point where I guess it would be from the first to maybe the revelation of the big picture, which was, I guess, right after the Florida 24 units. How many years was
Yeah.
that?
I mean, these are like long-term burns, right? Like,
Yeah.
so I feel like, and it's different for everybody. So I'm an engineer kind of at heart. I think I'm like, and I will say that I've raised very little money from engineers. They're tough people to raise capital from. Very
Sure.
exacting,
Mm-hmm.
very like want every detail.
Yes.
So I would say from when I first bought my property to when I decided to go out of state, that was like 5 years.
Mm-hmm.
And
Okay.
and it was kind of like just, going to real estate events and reading different books. And, it wasn't my primary thing. It was like, oh yeah, let me check this out. Let me explore it. Let me prove it out on my own properties, and then
Right.
move to like
Right.
investors. And then it was probably another 5 years before I raised any capital.
This is the reason why I asked this question, because, you said this experience, we can say, oh, I did this and this and this, and it's like in 2 to 3 sentences, but
Right.
that's always compressed into like 5 to 10 years. It's like, no, it didn't just do this in like 6
Right.
months,
And some people do, honestly. Like there's definitely people that are quick starters and like,
Sure.
just like get an idea and run. And like that's not me, but I appreciate the role those people play in getting things making progress happen. But no, for
Yeah.
me, it was like 10 years.
Yeah. I mean, it works.
Yeah.
I want to ask here, why, I was telling you right before we started recording on the show that, I'll get people to ask me hey, Arita, hey, Arita, my last name, interested in doing real estate. Should I get like a rental? Should I go into Airbnb or things like that? You went right into a three apartment,
Yeah.
a triplex. I forget.
Right.
And why did you ever consider doing something like a single family home, or is that just not what you were?
So I live in the Boston area, and it's in general, the more retail the property, the harder it is to get the numbers to work. And what I mean by that is like a single family or a condo, you're competing with an end user who wants to like buy that for them. So they're not running numbers on it. They're like, I like it. What's my salary? Can I afford it?
Yeah.
So if you're trying to run numbers on it, it's going to be tough to compete with that person unless you have some sort of edge, right? Like you're looking at really crappy houses that you're going to renovate, or so, then you go to like a 2-family, and there's a lot of 2-families in Boston too. So that the person you're competing with there is, I can afford this place if I rent the upstairs.
Right.
And as long as those numbers work with my salary, that's kind of what I'm willing to pay. And then eventually I'm sure I'll pay the mortgage off and make some money.
Yeah.
So you can run the numbers on those better than the singles, but the triples are even better. And then when you jump to when you jump to a 5, now you have a commercial loan. It's like a different, you don't go to like your local bank. You go to your local bank, you just talk to a different person there.
Yeah. Most of
the
time,
numbers, and they're asking like, does the property support the mortgage? And it's a whole different thing. So now it's a business, right? So now like you're competing with other people who are running the numbers, and so like you just get a better deal basically, or it's easier to find a good deal as you get to the more professional. So I kind of figured that out and didn't go towards singles or condos. I mean, making a single work in the Boston area is very hard.
I just wanted to walk through, that thought process for someone to hear that too, because I think that's so important, especially as we, talk to, people who are listening, which some of them may have invested a couple times already, that might have their own, their own home as well as maybe a rental, but looking at being a limited partner or investing some capital into a deal like some of the ones that you do. And so talk to me about what you're doing today. Fast forward, like you said, it's been over the 10 years since you really started working with investors. And is this the point? Like, what was the thought process to actually start EM Capital? And how did that go about?
Yeah, so that was so once I decided that I was going to try to raise money and grow this portfolio actively, I was still at my job. That's when I said, all right, I need a company, and
Mm-hmm.
I think I'm going to see if I can do this while I do my full-time job.
Yeah.
But I kind of knew that I probably wouldn't be able to. Um,
Yeah.
so I
Time's a
started EM
factor. So,
Capital in 2017. Started try to make broker contacts in these different markets. Introduce this investor pool to like what I'm doing. I didn't have anything to bring them yet, but just
mm-hmm.
make my friends and network aware this is something I'm working on. And then it was not doable with my job. Like the big
Was not
difference
doable.
between residential real estate and commercial, it's like a business hour job. Like brokers don't want to talk to you
Oh,
on the
yeah.
weekends or at night. Like they work
Right.
regular hours. I mean, they will if there's a deal closing or something, but they expect you to work during the work week because that's their job, and most of the people buying the bigger properties, that's their job as well. So it was just hard, taking calls at lunch and scheduling. It was a
Right.
pain. So I said, all right, in a year, I'm going to quit my job and go full time. So what do I need to do to get there? So I moved some money around, invested in some single family developments in the Boston area through some contacts I had that I was confident I could get a good return on, and sort of laid out
Mm-hmm.
some finances for like a 2-year runway that I felt if I can get 2 years, I should be able to get this thing going on my own.
Yeah.
And then, um, you know, started the company, or had already started the company, but like made a plan, went, quit my job, went full time. And that was 8 years ago now.
Awesome, man.
Yeah.
Congrats. So, and today you do what I was seeing is, of course, multifamily. It's value add, but you do A and B class. Is that right?
Yeah, we pretty much do like B and above, and we do
Okay.
15 to $60 million acquisition price. And I think the core is a value add, and what a
Mm-hmm.
value add means is there's something that could be improved on the property, whether
Mm-hmm.
it's exterior capital improvements. It's got a tired look and feel. It's got old amenities.
Mm-hmm.
Needs new roofs. Needs new parking lots. Needs new windows. Things like that. And then interior. So the interiors are classic, which means out of date, tired, beat up. And then we go through and renovate, every unit to between say 10 and $20,000 per unit, which
Mm-hmm.
means new countertops, appliances, cabinets, floors, plumbing fixtures, light fixtures, paint, and just make them look kind of fresh and new. And
Mm-hmm.
then you can charge a premium for those units. So
Modernize it.
really the
Yep.
goal of of any multifamily investment is to increase your NOI, your net operating income after expenses,
Mm-hmm.
because that's the number that every apartment building is sold on. It's just a multiple of that number, kind of a market driven multiple of your NOI. So there's a more tangible story to value add. You're like, my NOI today is X. It's
Mm-hmm.
going to be 1.5X in 5 years. And here's how I'm going to do it. I'm going to make the apartment look nice and clean from the outside. I'm going to solve, any crime issues on the property with, these steps. I'm going to renovate all the interiors, increasing the rent by $200 per unit as I go.
Mm-hmm.
I know how much all that's going to cost. So at the end, I'll have my 1.5X NOI, multiply that by the market cap rate or divide it by the market cap rate, and that's my sellout price. So,
Yeah.
it's an easier story. Now, we do have two properties that are doing very well that are kind of more manager value adds, or get them at a good basis, right? So one we just bought, the group had purchased it 3 years ago on a bridge loan
Mm-hmm.
at kind of
Core.
the top of the market.
Yep.
The bridge was coming up. They were kind of caught, and we were able to get it at a good price. in their kind of later hold period, the property had declined. So it had like a good amount of bad debt and just wasn't being operated that well.
Yep.
So we came in, got it at a good basis. We're clearing out the bad debt. It's already, dropped to like 85% occupancy. Now it's back up to 92.
Nice.
We're, doing some really minor value adds, like adding smart thermostats and like a app, like a smartphone entry system,
Mm-hmm.
which will increase the rent and add a tech fee moving forward.
Yep.
And that's just very clean deal. We call it like a momentum deal. Just kind of keep
Yeah.
it
Keep it
going and
going.
just keep it up. Right. So those are the two kinds of deals that we've been doing lately.
Right on. I know that's you were talking about things being pretty straightforward, especially with the underwriting or the analysis of the deal of, hey, this is what we got it for. This is, where the rents are at. This is the how doing the renovations to, force the appreciation or force the income, which forces, appreciation of it.
Right.
And then this is what we get at the end. And I mean, I think what's really cool is, I love the explanation you just had too, because it's so just simple. It's kind of by the numbers down the sheet, right? Of
Right.
we do this and this and this, and we get this, right? And
Yep. Right. And now there's a
um,
lot of assumptions in there.
yeah. Well,
Right.
talk about that then. How do you go from those assumptions to something more reliable?
So I think your four big assumptions are rent growth over the period. So we usually underwrite for 10 years, but we're looking for an exit at 5 years. So
Hmm.
that 5 year rent growth is kind of your key number. There's your exit cap rate. So what is that multiple that you're dividing your NOI by so that you estimate what your sellout price is? There's your value add premium. So if we renovate a unit, what do we think the rent increase will be? And then, yeah, I guess those are like kind of the big four.
Yeah.
And your cap rate, your exit cap is the biggest lever, right?
Hmm.
Like that, if that moves around by a half a percentage point, it changes
Big
your deal
difference.
quite a bit. And there's a lot of different kind of strategies of how to come up with that.
Hmm.
Historically, or the last 5 years prior to all the crazy interest rate moving around, we've always looked at it like in place today cap rate and add between 5 and 10 basis points per year of hold to
Okay.
be sort of conservative. So if you say we want to be really conservative, if we went in at a 5, we'd say we're going to exit at a 5.5 cap in 5 years.
You definitely have a strategy around it. Would you say it's also a good idea to, I mean, you probably do a fair amount of stress testing the
Yep.
deal as well, right? I think that's an important call out because, we just talked about how engineers, architects, I mean, there's a lot of software, like it's all software people listening
Yep.
on pretty
Like, what
much
are the
people
metrics?
in
Yeah.
the tech industry.
Yep.
And so, you're using words like, we think it's going to be, and I'm like, okay, Chris, tell me more
Yeah.
about the thing.
Well, yeah, you don't know, right? So yeah,
Right.
we'll just put a sensitivity table together about
Right.
like basically we do like exit cap on the top and then, investor return on the side.
Right.
And we'll be like in the middle and
Hmm.
you can see, what does this matrix look like if the cap rate's high, and then we'll do
What
another
goes?
one with, and then rent growth is another one. Like
Yeah.
we'd say average rent growth over that 5 year period is another sort of assumption that you have to make. And then really you can't verify them ahead of time, right? They are like future projections, which
Right.
is, any business has that same
Exactly.
conundrum or challenge. It's just that there's not that many of them in multifamily, I feel like.
And so that's a really good point too, because that's where the operational excellence comes in, right? And this is something I know you're big on. Of you've talked about, which is making sure that the operations are tight. You've got, you probably have a fair amount of things that you'd figured out, like, and turn those into things such as playbooks
Yep.
and your cadences and things like that too, right?
Yep. Absolutely. Absolutely. And, it's a balance. When As you get to the larger properties, you get higher quality property management.
Yep.
So there's kind of two kinds of property management. There's offsite and onsite. So in a 24 unit, the property management company is in town and they
Hmm.
manage it for a percent fee of the income. But if there's a toilet clog, like I get charged for that. Like there's they call a plumber goes out and does it, then
Yeah.
they bill the property.
Yeah.
Um, Over say 65, 70 units, now you have like a full-time handyman on the property. You have a
Yeah.
leasing agent on the property, and it's their full-time job, and the property is paying their salary to sort of address all the things. Those are easier to manage because you have dedicated people that can follow your processes and procedures, and you can set expectations with. And then you tend to just get better quality property management companies because they're bigger. The leasing agents, have like a career path. Maybe they can be a
Right.
regional at some
Right.
point. They have like, oh, I can be here for 10 years, like that. So you get better service and you pay for it.
It's economies of scale too. And,
Absolutely.
it's one of those things that, we've seen the models for different times when it's like, well, the more you buy in bulk, the more of a discount you get.
Yep.
The more you do something, the volume you get, well, you get those, you get people who do it professionally. And that's exactly
Mhm.
what you're talking about here too.
Exactly.
So,
Yep.
it's like, oh, the bigger I get, the easier it can go. It's just the
Right.
amount of zeros and it's the thinking and it's network. What else do I need?
Right.
Right. And
But we
setting your
did
target
find
right.
we did find this year that there's a tipping point depending on who you are. So we have about 1,000 units, and we had a property management company that was good in the Southeast, and they got acquired by one of the country's largest.
Mm,
And they kind of said, "Oh, this is great. You're going to have even more buying power, and you're going to have more resources." But what really happened was the integration was a mess. Like
got it.
absorbing this company was like it took all the time of anybody beyond the on-site staff. So all your support level just kind of disappeared
Right.
because they were all integrating their back end systems for like a year.
Yeah.
And then you just became like a blip on the radar of the bigger company. Like our
There were
1,000 units
priorities.
was not getting us any FaceTime with anyone who could make a decision. And then their processes were very bureaucratic. And so we had to switch. So there's definitely like a kind of a sweet spot for your size.
Yeah. That's a good lesson. That's a good
Yeah,
lesson too, right?
absolutely. Right.
I wanted to address, you've got this video where you answer these kind of FAQs that pop up, and I wanted to pull the thread on some of these things
Yeah.
for the listener. And one of those is, just getting to that question is, you talked a little bit about educating yourself when you first started. I get this question, right? And you talked about you doing it over a period of time as well, right?
Yeah.
But if you were looking back and thinking about, someone who is just getting in real estate today, they're this higher income person, they're accredited investor,
Mhm.
tech salaries,
Yep.
right? Um, and maybe they're having an honest conversation with themselves, and they're thinking, I may not have the time for this. Or actually, I'll just put this question to you: if they want to get real estate, what are some of the questions they should get started ask themselves, um, to get started into something that is not just a single family home?
Yep. Well, I guess it depends on what they want to do, right? Like, do they want to move? Are they thinking they want to be an operator? Like, are they a hands-on person? Or are they thinking they want to get involved in real estate at a similar level that you would get involved in a stock, right? Meaning
Mm-hmm.
like a passive investor. Like if you buy Apple stock, right? You're not
You're not
calling
making
them and
decisions.
giving your inputs, or you're not spending any time. You do the research, you buy it, you watch it, you sell it.
Yeah.
So it depends where they want to get in, what their goals are. But I would say,
Mm-hmm.
a typical W-2 job that's high salary, in reality, doesn't have a ton of time to be an
Right.
active investor, right?
Yeah.
And additionally, you can learn a fair amount about active investing by being a passive investor.
Mm-hmm.
Now, that being said, there's a lot to learn in the beginning. So I would recommend getting like a book on like Joe Fairless's
Mm-hmm. Best
real estate
ever stuff.
investing book is a good one. Yeah, the
Mm-hmm.
best ever. I think it's a great kind of the right level. It's not business booky where the first half is my backstory and the second half is a sales pitch and then there's like one page of actual information.
Yeah.
But it's also not like a real estate textbook from Sloan or
Right.
like Wharton. You'll just never
McGraw.
get through. So I think it's a good in between. Um, just to kind of understand what it is, right? Like what is this business model? And then I would say it's talking to operators about their track record and getting a feel for like how they operate and what they do. Because, a big difference between real estate and say the stock market is these are publicly traded companies. They get audited by, big financial institutions.
Yep.
All your operators are really you're investing in the people and the company. And generally, they're not that big. I mean, some of them are relatively big, but generally, you have a handful of people that this is what they do all the time, and you have
Right.
to be comfortable that you're trusting them to a degree. There's there's PPMs and there's agreements, but what you're really doing is you're saying like, I believe in your business plan. I've evaluated all the items that you've presented, and I have questions, and to some degree, unless you really want to go and like verify every single thing
Right.
that group has already done, like what is the area median income in
Right.
Conyers
Right.
County, Atlanta? Like, is that true? There's a fair amount of trust going on, so you
Yeah.
have to have a relationship, I think, with the sponsors, and a lot of that's track record. That's something that helps, and then just interactions. So as far as questions, I would ask is, what is your track record? How do you communicate to your investors? How transparent are you? What are your deliverables like on a routine basis going forward?
Hmm.
And then some of the things we talked about, like how do you justify your key assumptions, like
Hmm.
exit cap rate, rent growth, revenue on renovations. Like those are pretty key levers. Like you move, if this is all the big spreadsheet model at the end of the day.
Right.
And if you move your assumptions of those numbers, the returns change.
Yeah. It's going to affect something downstream.
Yep,
Definitely.
absolutely. And you were saying like you do a sensitivity analysis, or we do one, and you do downside stress tests. But really, in reality, if you underwrite a deal ultra conservatively, you will never buy a deal,
Right.
right?
Yeah.
So you could
So,
you could do that all
so
day.
I, where this is headed, this conversation is something that I've been thinking about a lot here. So I'll put this question onto you like that. But like you just said, if you're ultra conservative, you're never going to do a deal. You're never
Right.
going to walk outside. You're never going to do anything. And
Yep.
so it's really a conversation about risk and knowing
Hmm.
how to mitigate some of it. Right. And so looking at your key assumptions, like you're saying, what evidence do you have to substantiate that? And what
Yep.
happens if this number goes up or down? What does
Hmm.
that do downstream?
Yep.
Right. Nothing is guaranteed. And that sounds, might have like red flags waving in the air, but like you have to know
Right.
what you know and go from there. And
Yep.
so, the next step on this is like, all right, cool. I trust who I'm talking to. Chris seemed like you got your stuff together. It's everything checks out. But there's this, okay, well, what am I investing in? Often
Yep.
people have never invested in the 25 or 50K or even 100K into a deal like this.
Right.
I mean, is that about what the investment dollar amount is for
Yeah. Our average
most
is
of
about
your?
100, and
Okay,
our minimum is 50.
cool. So, um, what do those convert, or do you ever have any objections from people, or just like, oh, that's a big number? Like,
Yep.
what does that look like? Because I know there's people listening, they're doing this for the first time. It's like,
Yeah. So, I mean, we're pretty clear up front. Like these are the minimums. So that way, like we tend to not have those questions too much because, I'm not
straightforward.
really on call if people aren't, in a position to invest that much. But it
Yeah.
really, from our perspective, just comes down to logistics. So if we're buying a deal for $30 million and it needs 10 million of equity, you know,
Just math.
it's just math, right? Like every, if it's $100,000, what's that? Like 100 people,
10 mil, right?
right?
Or
So
if you're
if
doing
it's,
100, yep.
yeah, so if it's $50,000, that's 200 people. That's just
Hmm.
a lot of, I mean, to be honest,
A lot
cats
of
to herd,
people.
right? Like
Yep.
a lot of paperwork to sign, a lot of questions to answer, a lot of phone calls. So you sort of like just set a minimum and say, anything below this, like if you went down to 10K, I mean, it's undoable. You would need to hire extra staff just to handle lower income, lower equity you raise. So that's really
Yeah.
just the logistics of it. If you want to scale, on our side, without a platform like a Fundrise or something like that.
Right.
And
I
then
and that's making sure that you have, like you said, you've well, that's perfect. So it sounds like it's just logistics. People already know coming in, this is what it is. And if
it
you
is
can't,
right.
then maybe down in the future we could work together.
Yep. And then there's an element in reality from a sponsor's perspective in that someone who's going to cut a 50K plus check can handle that. It's not like all their money, right?
Right.
Um, and they they if they're accredited, to some degree they at least have the net worth to that. It's again, it's not all of their money,
Yep.
and there's a presumption that they've done other investments, so they're like financially literate to a degree that they're understanding it.
Hmm.
And really the last thing that I want is someone who like is like, yeah, totally, like great, like has no questions. It's just like
Hmm.
sends you a check, and then in the future, if something doesn't go right, has like a million questions and feels like taken advantage of.
Yeah.
Like we
Yeah.
want investors that are like knowledgeable, can ask hard questions. We'll give you answers. We'll tell you when we are making assumptions, because assumptions are certainly made. They're
Hmm.
based on data, but
Yeah.
this is a future projection. Like we don't know what's going to happen. Um,
Right.
and they grasp all that. And that tends to come with bigger checks, to be honest. Like writing a 50K check means I'm going to ask the questions that I need to ask. And maybe
Yeah.
writing a 10K check is more kind of cavalier.
Yeah. That's it's great to hear your experience about that too, because even with investors, you want to make sure that you have the right people because they're your customers. They're your
Yeah.
customers as well.
Oh,
And
absolutely. Yeah. Yeah. I think
boy,
about
are they
that.
your
Like we have two
customers.
sets of customers, right? We have investors and we have our residents. And I
Yes.
think a lot of people focus only on the investors, and the residents are a different kind of customer. I don't interface with them all the time, but they're really the customer. Like
Yeah.
they're the
Yeah.
ones like funding the business. So, um,
Right. Everyone
yeah.
needs to be communicated to properly.
Yep. Yeah.
Uh, okay, cool. So people, investors, you'll have whatever set of conversations, set expectations, do the education, make sure that they're the right fit. What comes next is something like a subscription agreement. This is that document that investor signs, which shows their interest as being part of the deal.
Yep.
Anything else you want to mention about the
Yeah,
subscription
sure.
agreement or anything else as they go into the deal?
So typically we have an investor portal that has all our kind of pre material. So we'll have like a slide deck on the everything that the investment, the business plan, pictures, the team, the
Hmm.
property, the area demographics. So you review that. It's on our website. I think it's depending on the deal. It's like open, so you can just kind of go in.
Hmm.
And then if you're interested, you can express like a soft commit. So I'll put in 100K. Here's my
Yep.
information. Set up a little account. Now I'm soft committed. And then the deck effectively gets turned into a private placement memorandum, which is just a legal summary of the deck, effectively.
Hmm.
Here's like legally what the deal is, and a million disclaimers that your like syndication attorney requires you to put in. So it goes from like a 40 slide deck to like a 120 page thing,
Yeah.
but it's kind of the same thing. Um, and then there'll be a subscription agreement that says, "Yep, I've read this." And then there'll be an operating agreement for the business that we're going to set up that the investor will be a part of. Read those two things. Yeah, I'm comfortable. And then there's an online portal where you sign the subscription agreement. Reaffirm. Yes, I want $50,000 or $100,000.
Yep.
It defines what that means. That's X% of the
Hmm.
deal. Based on the size of the deal. There'll be a min max raise. So say we as you get closer to the closing, you know exactly how much you need, but there's legal fees and a lot of estimating going on. So say we
Right.
might need, 10 to $12 million is what the raise is. So, your percentage
Awesome.
will be, between two numbers, and then once you close, it's set based on the total raise. You sign the subscription agreements, wire in your funds, get it. Your portal holds the signed, agreed document that states, what your interest is. You can download it. It's a PDF.
Hmm.
And then effectively wait for the closing announcement. And then once a month, we send out an investor newsletter that just says kind of what's going on with the property, what are the resident events, has the link to the financials,
Hmm.
gives you sort of a capex summary, And then quarterly, we send out returns, which are done like through the portal as well, like via ACH.
Cool. And that'll usually come after the property is stabilized or you start to do the improvements
Yeah, I
to
mean, it
get the cash.
depends on the property, but typically 6 month kind of is the time frame that we can start giving something. And another thing to mention is typically these deals are set up with a preferred return and then a projection of an annualized return over the life of the deal. So, say a preferred return would be 6%. And what that means is that the investors will get up to 6% first before the sponsors, myself, get anything. Now, there's also cash flow projections. So say you have a 6% preferred return, and year one the property only produces 3% cash flow based on like the investor capital. They just get all of it.
Right.
So they
Because
get
it
their
hasn't met the
3%.
6 yet.
Right. Hasn't met the 6, so they get all of it. And then what they didn't get, that extra 3, gets carried forward to the next year.
Got
So
it.
the next year,
Talk to us why is that important? Because this is an important note on what's called
it
that
is.
waterfall of how the cash goes and investor and sponsor alignment, right?
Yep. And that's how our deals are. They're not all like that, but I think it's kind of standard. So it really means that like the sponsors don't get any money out of the deal unless the investors get their pref. Now it doesn't mean they're going to get it every year, but all that keeps pushing to sale as well. So if you got every year you got 3%, well you'd have that 3 times 5, so 15% catch up at the end that you would get paid out at the sale before the general partners got any of their cut.
Got it.
And so I think that is an area of confusion, is the pref versus the projected cash on cash per year. Sometimes we maybe could do a better job explaining that. And an investor say, hey, the year's over and I only got 3% this year. And the pref 6. Well, yes, but the property only produced 3% this year.
So before we go, talk about that part, because if I'm hearing that and I'm thinking, okay, we've gotten this far in the conversation, and you're saying, what if the property only does something like 3%? There's also that question of, well, why should I do this versus investing in the stock market, which I know like expands the conversation a lot. But can you address that? Because it's like that 3% is like, well, is this even worth it versus doing a public market?
Absolutely. I think it fits in a spectrum, right? So I kind of view like a treasury bill or a CD is kind of your most solid.
Sure.
I think real estate falls to the right of that on a kind of risk reward spectrum. And I think the stock market, I think historically falls to the right of that, right? Like it's got a higher projected return, but it's more variable or more volatile. So a lot of our deals, we're projecting between 15 and 18% annualized return, which I believe is above the stock market kind of historical average.
The 8% average.
Yeah, we hear 10 or 9, but depends where you start, right? So I think we're paying a higher return due to that sort of risk and the lack of liquidity in the deal, right? Like you can always trade your stock. Even if it's down 5%, you can still get that money back. Whereas our deals are, you could sell your share, but you would have to find someone to sell it to, which is a problem, like in of itself.
Your LP share, you mean, within a deal? Yeah, that doesn't really happen that much.
No, it doesn't happen. And I mean, yeah, we've seen it happen, but it's rare, and there's not a market for it. And typically our LP investors are not in a position to tap into what limited market there is for that, because they're not real estate professionals. So you're effectively locked into the life of the deal.
Yeah. So, I mean, just my thoughts on this too, and anything else you want to cap on there before we close is, they're, like you said, being able to, your returns are actually, your projected is somewhere around 18%, right? For
15 to 18 annualized rate of return. Yeah.
Perfect. And so that's still more than for the risk return profile for something like a stock, which could be that 8% year over year. But the thing is just like you said, is that that is that average, but that could have been way low as well. Like 1 year, like that's averaged, but you could have lost a ton of money 1 year, and then it's up back over whatever percentage of time, that they're annualizing this 8% versus the 5 to 7 year hold that you're talking about. So
Right.
paying attention to the time to get a number is important. And there's
Absolutely.
also
Right.
there's also premiums with being able to liquidate, right?
Yep.
Buying a stock, selling a stock. And so it could be a really good thing too. And there's way more on that, but
That's a whole topic. Yeah. Right.
yeah,
Like,
I know.
yeah.
Hey, listen, I just wanted to close out, we went through some really cool stuff here. You talked about how you love doing this stuff. You love real estate. You shared about that earlier too, and you're looking to grow the team a little more. But you want to stay into the details of the business. Well, what can you tell us maybe a little bit, like, what is it that you actually enjoy?
I like the ability to kind of affect change, right? Like one of the big problems I had in the defense industry was that the projects were so big and had so many players that like a great idea had literally zero chance of moving the needle. Like it was like you're swimming next to a battleship and trying to push it. Like it's just not going to do it, right? Like
Yeah.
I like the fact that we can buy a property that like looks rough. Like you see, like I can like this property in Georgia that we bought 3 years ago. Like it just looked everything wrong with it was the right stuff. Like the landscaping was overgrown, the roofs were bad. Like I was like, oh my God. In like a month, this place can look way better, and like it's just I like the fact that we can do that. Like you can buy it, make it better in a relatively straightforward way. I mean, there's a lot of problems. I could do a war story podcast with you, but it's not all easy. But and then in the end, you have this like better product with like happier residents, and then you've like made money for investors. Like almost the discreetness of it and like the ability to really have an impact. I just really like. And then other businesses, I mean, every business has assumptions, right? And I feel like there's even more of them in most businesses. It's like more complicated, which I'm not sure I really have the knowledge and like interest in like wrapping my head around like like something that's more complicated. I think it's like my sweet spot.
Awesome, man. Income impact, helping investors, helping the community, helping the residents. I think everyone on listening can appreciate that because we all want to make that impact too. So, Chris, dude, thanks so much for being here. Where can people find you? And what would you love to talk to them about?
Yeah, you can find me on LinkedIn, Chris Lento, and the company is EM Capital. You can also find me at emcapitalgroup.com. And then that's pretty much all the social media I do. So, and then I'm Chris Lento at emcapitalgroup.com.
Solid. I'll make sure it's in the show notes. Appreciate it, brother. Thank you.
Thanks
and we definitely got to do some more stories. Maybe we'll do a podcast just on that.
Yeah, those are fun.
Thanks for joining us on another episode of Path to Passive. We love connecting with our listeners and those on the path to architecting their wealth and improving their lives. Feel free to let us know what topics you'd like to see in future episodes. Get in touch with us through email or Instagram. See you next week for a new episode.